The next section we're going to take a look at is policy, the impact of policy. When we look at government policy, it breaks into two components: fiscal, which is tax and spend; monetary policy, interest rates, money supply. In the U.S., this policy here is the Federal Reserve. In this case, it's the President and the Congress. Let's take a deeper look. You have policy output, things actually being done by the agencies. Then there are results and the consequences for society, intended or unintended, that stem from deliberate government action or inaction. It's not just financial issues, but social actions at the same time. And in global, it's different. Different countries approach this differently. But the impact, is a mix of the outputs and the outcomes, the results, if you will. So as we're going forward, businesses are obviously operating within this environment, and they're making decisions, from a financial perspective and or how do you organize a team, and how do you run a business. So we're going to take a look at government spending, taxes, interest rates and other Fed actions, and then healthcare. There's a lot of other areas that we can look at, and but at this point we're going to leave it at that. We did cover climate change in the previous one, but I think that is going to, again, a lot of policy is going to impact that, as we've already seen. Well, let's start with government spending, and a couple of things happened there. And we've had the base that's been running, but starting last year in March, there was the coronavirus preparation and response. They put $8.3 billion there. March 18th, Families First Coronavirus Response Act, another 3.5. Then a week later, there was the CARES Act, which was $2 trillion. So as you can see, the government really moved fairly fast in spending money. A month later came the Paycheck Protection Program and healthcare enhancement. That was another $310 billion. In January of 21, we had the American Rescue Plan, $1.9 trillion. And when we looked at how that breaks down, the CARES Act, which was the first one, $560 billion to you and I as individuals. Big corporations got $500 billion, small business $377, and governments $339. They put $153 into public health and some into education and safety net. But that's how the first big bill broke down. Now, when we move into the second stimulus, that's $1.9 trillion. You can see that a lot of it went here to stimulus, and it breaks it down more on extended unemployment programs, 256, tax credits, transportation, grants to restaurants. A very inclusive that dealt with a lot of different things. But again, it was trying to prop up and get the economy back on track, take care of people when we had the unemployment rate at 15%. Now, you take these spendings, add it onto our base budget before, and you can see that we're spending a lot more than we're taking in taxes. Okay? So now, let's keep going with that, as this is the Biden Infrastructure Family Plan. And as you can see, everything is in this plan. And this is going to turn into both a political issue, but a lot of policy issue in there. Some of it is, if we're looking here, roads and bridges, that's what we'd expect in an infrastructure. Waterways and ports, airport, railroads, public transport, road safety, electric grid. But now all of a sudden, eliminating lead pipes. But now we got electric vehicle incentives. Think about that for a second. Whoa, that's really a lot of money. But lot of so many different things in here in this spending, if approved. And I don't think it's going to be approved overall. There'll be a plan, but will everything be there? There's a lot here. Take a moment and look at it. So that's spending. And since beginning of COVID, we already had a deficit, huge deficit. We're spending more. We're even spending more and more. So really the government spending is what's stimulating the economy and growing. So the question is this sustainable, or is this a one-time thing to prop things up? I'll leave that for you to think about, but take a moment, look at this slide and really see how much is there. And on some of it, you might say, okay, well, yeah, no, we don't need to spend money on that. But this becomes a discussion, okay? Why should we put money into in-home care for people with why would we do that? Why would we give 2 free years of community college? Why would we put Pell Grants up so much more? Where should we cut on this? Is there anything here that we really don't need? And I think you'd probably say, well, maybe not as much here, but we don't know. So there's a huge spending thing going on here. We then look at tax policy, which is the other side. You spend and you tax. They really have 2 aspects to taxes. One is to generate revenue, okay? To generate revenue for the government to pay for expenses and projects. At the same time, it's to encourage certain behaviors, okay? We're going to do a tax credit or additional tax when we're trying to change a behavior. And that's spending by you and I as a consumer or companies. The intent is to use taxes to cause an action. So it's important to note that distinction in tax policy. The first thing we had back in 1718 was the Tax Cuts and Jobs Act. And when you look at it as an individual, you see how it was divided up. And what you can see is it was really, those in the lower level didn't really make anything, but the cuts went primarily to the wealthy. And, you know, it is what it is. And the expectation is that it would trickle down to others. They'd spend it. Didn't turn out that way. Corporate tax rates, we went from a rate of income under 50,000 was taxed at 15, 50 to 75 at 25, 75 to 10 million, 34, and then 35. That was just brought down to 21% flat rate no matter what. The majority of these savings, the intent of this was to spur investment in property, plant, and equipment, research and development, hiring people. Most of it, unfortunately, went to pay dividends to shareholders and buybacks of stocks, and not investment. Okay, so that's what happened there. If we're looking forward, the Biden tax plan does a couple of things. It raises the top income tax rate from 39.6 from 37 to 39.6, raises the corporate tax rate from 21 to 28. It does a few other things here. It does impose a 15% minimum tax on large companies. If you look today, most large companies don't pay much of a tax. So this is a plan that is focused on basically, as you can see here, nobody really is impacted if you make basically under 400,000. And if you go from 275 to 675 with an average income of 400, your tax goes up $1,500. But the real money comes in at the richest, those that make 675,000 or more. And that's only 1% of the population. And their average income is $2 million. But you go back and see where this is going, the average person is not being hurt by this. The wealthy aren't, sure, but where do you get to the point, how much money do you really need? And I guess that's a social commentary I'm making. But again, it comes back that our deficit keeps getting bigger and bigger on the fiscal year, where we ended up in 20, and look at where we are so far in 21. The deficit is going to be huge. So that's when we look at it. We got government spending and taxes. So what we have is the government spending a massive amount of money. Prior to COVID, we reduced taxes. Of course, that caused the deficit to go up, because if you spend more than you take in, you don't win. You can only keep that going so far. Now the government is spending massive amounts, so it's got to fund that somehow. We'll see what happens. It'll be clearly a quagmire. So that's the first is monetary policy. This is done by the central banks. Almost every country has a central bank. Some are independent of the government, and others are dependent. In the United States, the Federal Reserve Bank is independent of the government itself. Congress oversees the Federal Reserve System and its entities that relate to it. So they're governed by a board of governors, different reserve banks, and supervised by the board of governors. Then there's the Federal Open Market Committee. This is probably the most important part of the Fed. What is their focus? The Federal Reserve has a dual mandate: price stability and maximum employment. So they're balancing that. Price stability means that the economy is not experiencing high inflation or deflation. Experience over time has shown that the economy performs well when inflation is low and expected to be remain low and predictable. And maximize employment. So it's this balance. Now, we have been, prior to the COVID, we have been in that maximum employment zone. We've had minimal inflation, so the Fed has achieved what it's want. Now, that has changed with what has happened with COVID-19 and the employment situation that we talked about. The Fed has a couple of policy tools. One is that it runs an open market ops, which essentially is just buying and selling treasury bonds. And this is the major form of monetary policy, is buying and or selling government securities. There's the discount window, and they lend to member banks. And what they're trying to do is target through this the Fed funds rate, which banks pay between each other. They can also change the required reserve ratio, how much banks need to keep aside. And these things here affect short-term rates. Long-term rates are set by the market. Now, what we've seen is over the past, this goes back to 94, we've seen inflation, the highest it's been at 275. The target is 2%, has been. Okay? And during expansion, we've seen it close to about 165. Now, what's happened is we've moved into this. The core inflation is down. Now, that doesn't mean everything is down. That just means this basket of goods is. So food prices are up where other things are down. Travel, clothing. Okay? So this is, they're trying to create these jobs and keep stability with low inflation. But they're going to try to let it run up a little bit. So it's way down here, and they were hitting the target just here a year or two ago. But this is a puzzle they're trying to figure out. But what drives that overall? Yes, the Fed's actions can. But it's supply and demand, what we talked about at the beginning. The more money is in demand, the higher the rate. The lower the demand, the lower the price. They also look at the risk and return profile. The longer you lend money, the higher the rate. The shorter the term, the lower the rate. The greater the credit risk, the higher the rate. The better the credit, the lower the rate. So this is a supply and demand fixed by the term, tenor, as we might say, and the credit of who you're lending to. U.S. government securities have no principal risk because the government can always print more money. they do have inflation risk, so that's an important thing to keep in. Here we have a picture of where interest rates are as of today, May 20th. And what you can see, and I've highlighted the 10-year note here, and I'm looking at it over a 3-year period, where go back to July of 18, which is just 3-4 summers ago. We were looking at a 10-year rate. This is the government rate for money the government can borrow for 10 years. And it was pretty low at 3.25. It dropped down in January through July. It was under 1%. Think about that. You could put money away for 10% for 10 years and barely get 1%. We're now up just under 2, 1.625, 1638. Sorry, I did that wrong. 1638 is what is at this morning. But if you think about inflation, what we were seeing, it's below the inflation rate. So you'd be losing money by doing these. Okay? But look at how cheap money is here for 1 month up to a year. It's not even 5 basis points. So the question is the bond market anticipating inflation? Because if it was, we'd see a much higher interest rate. So that's the impact of policy. That's that. So that's the policy. We're only take a look at the healthcare policy, which is currently the Affordable Care Act. And when the Affordable Care Act was passed, it moved to a more prevention and lower cost-based model instead of an emergency response. Lower cost, better outcomes. A hospital has to treat you irrespective of your ability to pay. So the way the Affordable Care Act was structured is that you could get more preventive care and not wait till it's too late to get into, and if it's too late, then you get into the hospital and you have more complications, and that becomes more costly. The other thing it did is it standardized coverage definitions, including mental health and chemical dependency. Prior to the Affordable Care Act, there was no standard definition. You really had no clue what your policy was covering or what it wouldn't, which left a lot up to healthcare companies. With the Affordable Care Act, they standardized, you have to define certain things. You can do add-ons and other things, but there's a standard definition if I'm comparing policies. From your benefit, adult children covered to 26. If the Affordable Care Act is struck down by the Supreme Court and it is pending in front of the court, you have a problem because you won't be covered under your parents' policy anymore. So you're going to have to figure out, how am I going to get health care? You can't be denied coverage because of pre-existing conditions. So when you look at it fundamentally, despite what you think, there's some really major benefits from the Affordable Care Act. You're impacted positively by it. So if it is struck down, start thinking about how you're going to obtain health insurance and if you can even afford it. 10% of the population uninsured. It's more today. 30 million people have no health insurance. So they don't have any health insurance. Whenever it gets, they have a small problem, they don't go to the doctor. If they have diabetes, they may not be taking their insulin, heart medicine. And that becomes very, very sad, but it also costs the taxpayer money and hospitals money. Because when they go to the emergency room, they tend to be sicker and they have to be treated, irrespective of their ability to pay. When we look at this, 46% of Americans are covered by employer group plans. Medicare, which is for seniors, is 18%. Medicaid, provided by the states, is 16%. Obamacare is about 7.2%. And then the uninsured is still about 8.4%. So you probably got 60 million people that could be negatively affected by that in the healthcare space. What's interesting here is that the U.S. spends $10,348 per person average, compared to Switzerland, Germany, Netherlands, Austria. Actually, we spend more money than anybody else, almost double in many cases relative to the average. So then you might say, wait a minute, with that, we should have the best health care. Well, when you look at outcomes and risk factors, let's take a look at a couple of them. Life expectancy at birth. U.S. 78.8, 81.2. Not working there. Infant mortality. These are the number of deaths per 1,000 live births. 6.1. That's significantly more than the rest of developed worlds. Look at the percent of population 65 or with 2 or more chronic conditions. 68. Okay, we look at Sweden, Switzerland, UK. These are big differences. Obesity, we're the biggest. Percent of population are daily smokers. Hey, we're actually pretty low in that. Percentage of population age 65 plus, 14. These countries tend to be a little older, but they're healthier. So we're spending more and we're getting less outcomes and risk. What's the difference? All of these companies have single payer insurance. We don't. When you look at, this is another scary one, the prevalence of opiate use. We're almost 6% of the American population uses opiates. Okay, and then you work your way down to the others, it's not there. We have a lot of other policy, and they involve energy and environment and energy, healthcare, transportation, worker safety, consumer production and finance, agriculture, and immigration. And there's a number of these that the current administration is trying to implement. And whether they're good or bad, a lot of them, they're in regulatory. Okay. Environmental being a big piece of that. Safety. And these things are very important. But at this point, with some of those things, you don't have to worry about the environment anymore. Who needs safe drinking water anyways, So that's sort of other policy. But there's long-term impact of these. Okay. It's not a short-term thing. Putting it together, wow. I don't know. It's unknown. There's so many different variables that go into the future as we move into 21, and a lot of risks which we can manage. But have hope. There's opportunity. And I think you look at this, it'll pass. Can we have a growth mindset? What can we do to benefit ourselves? How do these things impact you personally? Good question. Jobs. Predict jobs that will be in demand over the next 10 to 20 years when you will be working. So you can focus on your skills development so that you can have a job. Ability to support oneself and family. Oh, by the way, not a low-wage one here, but a high-wage one. Ability to support yourself and your family. Quality of life. What do you want to do? Do you want to travel? What do you want? Ability to create wealth, planning for your future. So these are important things that impact you as an individual right now, December 9th, 2020 and January 2021. How does it relate to the courses we're doing? Firms operate within this environment. The issues discussed impact the strategy the firm takes and their ability to achieve their goals. That helps us interpret financial data. They make capital decisions. That includes human capital, planning and actions, recruiting, training, retention, compensation, performance management, and plan for production, including people. So there's a lot here, but as we move forward to look at the firm from a finance or organizational perspective, the firms operate in these environments that are impacted by these trends today and in the future. So if we want to be able to understand the future and where it is going, we need to understand the environment and some of these mega trends. So if you have any questions, please let me know.